Okay, welcome back to the part B. And as I explained earlier, this is gonna be a heavy lifting part, but don't be scared. We're gonna explain it in detail. I'm gonna explain the details. Okay. Okay. So first of all, we needed to estimating know how to using allowances. Let me go. Uh, Okay. So we still talk about accounts receivables right now. So we wanted to understand how to taking care, uh, how to estimate the amount that we cannot receive. And you will be like, okay, why would you even talk about that? The reason is when you give credit to someone or you trust someone gonna pay you, it's normally would not be that case 100% of the time, right? The reason is the downside of extending a credit to a customer is that not all the customers will pay fully on their account. And even most well-meaning the customers sometimes find themselves in a very difficult situation, right? Beyond their control or limiting their ability to pay the debt. So customers accounts that we are no longer consider, right, accounts receivable, we are no longer consider that we can collect. We will be called uncollectible account. Or another name is called bad debt. Okay. So general accepted accounting saying that we need to use allowance method to record our uncollectible accounts, right? When some accounts receivable will not be collected, we need to record bad debt expenses. And what does that mean? Specifically, it means that general accepted GAAP accounting requires that we account for uncollectible accounts using what's called allowance method. Okay, and under allowance method, a company reports its accounts receivable for net amount expected to collect. And to do this, a company must estimate the account of current accounts receivable that will prove uncollectible in the future and report the estimated control assets. Okay. In other words, first of all, you will estimate, okay, how much you are not able to collect uh, while you will not even know whether it's gonna be collectible or not. And then you also have to not only you have to estimate it, you also have to record this estimation in the current year. In other words, so if you offered a credit sale in this year, you say, oh, accounts receivable and credit revenue, right? You say that. And then, um, so the minute you say this, you will ask yourself, how much of this I really can able to collect? So, and as always, we believe the best meaning, the meanwhile company might not even able to meet the ends. So therefore, we are required by GAAP to estimating a portion of this accounts receivable, not like prepared for the raining days. Hence, within year one, we need to estimate the proportion of this accounts receivable not being able to collect it. Okay, so hence that I so this estimate uncollectible accounts will reduce our accounts receivable because we will consider it as a bad debt expense. Bad debt, bad uh, bad debt means things that you cannot collect. Bad debt, right? And your credit account called the uncollectible allowances for uncollectible account. I know right now it's a little bit overwhelming. I just want to give you an example. So by doing that, you are increasing bad debt expense by debiting, right? Bad debt expense, this amount, you are increasing the balance. At the same time, you will record allowances for uncollectible accounts on the credit side. And this is a control asset account. Control asset account, meaning it's reducing the asset. So by doing this transaction, you are increasing expense and also decreasing asset. It's a balance, right? Because expense and assets are on the same side. Okay, so let's see. And by the way, the most important thing about this this transaction is that it's the first time ever you need a recording something has never happened yet, right? Those earlier transactions we learned from chapter 1 to chapter 4 are always recording things that have already happened. But in this chapter, on the allowance method, we're recording things that has not even happened yet, okay? And that's why we call this conservatism. So accountants are more conservative than other professions is because we always consider worst scenario, bad scenario. So, and under allowance method, company are required to estimate the future uncollectible accounts and report the future uncollectible possibility into current years. Okay, you recognize this bad debt expenses this year. Okay, there are 3 stages of the process. The first stage is at the end of initial year, establish an allowance by estimating future uncollectibles, right? And during the subsequent year, you will write off the actual bad debts uncollectible, right? Actual write-offs may differ from the estimation. And at the end of the subsequent years, once again, you will estimating future uncollectible again. So we first learn the step 1 is to establishing allowances for uncollectible accounts. So base the estimate of the bad debts on the balance sheet amount accounts receivable. And also it's called the balance sheet method. Another way is that if you say you have a $20 million accounts receivable, based on your experience of dealing with your customer base, how much portion that you think is not able to collect, you will credit that portion on the allowance account. Yeah, allowance for uncollectible account. So we will call we will open a T-count allowance for uncollectible account. I just abbreviated for you a receivable not expected to collect, right? Okay, give you an example. At the end of 2021, Kingsley is owed 20 million from customer. Is owed, meaning that customer owe Kingsley 20 million, and estimated about 30% will not be collected. So therefore, December 31st, they're gonna have to estimate what the future uncollectible account is, right? Yeah. So by debiting bad debt expenses and crediting allowance for uncollectible amount for 6 million, and the 6 million is collected by 20 million multiple 30% is the 6 million. And bad debt expenses is reported in the income statement in 2021, right? And allowance for uncollectible account is the control asset reported in the balance sheet under the accounts receivable account. It's reduced the balances of accounts receivable. So another illustration of the timeline I want to give you a more clear understanding is that, first of all, in 2021, which is our current year, you made a credit sale. You believed your customer will pay you in the future. You made a credit sale for $50 million. And by the end of this year, which is December 31st, you find that you have 20 million out of 50 million haven't collected yet. Okay. And then you tell yourself, based on my estimation, next year, I believe 6 million out of this 20 million is not going to be collectible, meaning that people are going to fail to pay you, and only 14 million will be collected in next year. Hence, if you have such an analysis, then on your balance sheet, you were expecting to see 20 million accounts receivable parked, right? At the same time, you were creating allowances for 6 million to record and tell your shareholder that out of this 20 million, there's a 6 million. Please do not expecting that we will get paid. Okay. So, and we call this the control asset account. That's why we put it in the negative, right? And then the net account receivable is $14 million. Okay. Then what is this journal entries impact on the income statement, right? We talk about balance sheet. So remember, we recorded bad debt expenses, right? And then we record allowances for accounts receivable, right? And then we record 6 and 6 right here. So this bad debt expense is gonna hit the 2021's income statement, be considered as expenses subtracting from total revenue of 2021. Okay. So therefore, this journal entry is gonna reduce current year assets, also increase current year expenses, which is reduced net income for current year. The common mistakes that students might make is that because allowances of uncollectible account is always have a credit side balance, right? It's already no one have a credit side balance, and you will misclassify it as liability. But which also have a normal credit side balance, that's understandable. But actually, what we are talking about uncollectible account of this allowance is not a liability account, it's actually an asset account. It's called a control asset account. Okay, control which asset? Control accounts receivable asset. Okay. Which of following is true regarding allowances for uncollectible accounts? Okay, is it a liability account? No, right? We just talked about. Is it added to the total sales discount and the sales return and sales allowances revenue? No, right? It has nothing to do with sales. It's an asset account. It's a control asset account. Hence, it is subtracted from balances of accounts receivable in the balance sheet. Yes. Okay, DY is not right. It appears in the income statement as an expense. No, right? It's live in the balance sheet. Yeah. The allowance account is a control asset account is used to record and estimate the future uncollectible accounts. The balance is subtracted from accounts receivable in the balance sheet. Subtract from accounts receivable to arrive at accounts receivable carrying value or net value. Okay, so second step. Step 1 is to record the sales estimating uncollectibleness. Step 2, what happened in year 2, right? What actually not being paid? What actually did not collect, right? And how do we deal with the actual uncollectibles? Okay. So the write-off an account receivable occurs when the company really identifies, okay, the specific account that has become uncollectible. At the year 1, you're actually estimating it. And year 2, you really experience people really didn't pay you, okay? So when it becomes clear that the customer will not pay, the company needs to write off the customer's account balance as uncollectible. Because on your book, you still say David, right? David still owe me such money, right? Say 1 million. although you estimated allowances for uncollectible account for David is say 200,000, but it's your estimation at that point at year one. But right now, when the year two comes, David really didn't pay you. Let's say not 200,000. He didn't even really pay you more than 200,000. You underestimated. You underestimated his uncollectableness, or you overestimated his paying ability. So he actually didn't pay you 300,000. Then how do you deal with this 300,000? That's what this meant. And we call this 300,000 actual uncollectibles. And then in accounting, we call it how do you write off this collectability of this $1 million. First of all, you're going to reduce the account receivable balance, because when you experience that David cannot pay you actually even 300,000, you should reduce the accounts receivable from David from $1 million to 700,000, right? At the same time, you need to reduce the allowances for uncollectible accounts, because you already realize this account uncollectibleness is true. Okay, so write off. So basically, you will debit allowances account, and then you will credit accounts receivable. Because first of all, you will reduce the accounts receivable that you're expecting from David, right? By crediting accounts receivable. This is easy to understand. Why are you debiting allowances on collectible account? Because you already realize that this accounts receivable, the proportion of accounts receivable is never going to be collected because it really actually happened. Hence, there's no meaning to hold that allowance account for this account receivable anymore, right? So therefore, you debit it. Okay. So the write-off, so if you notice, what is the impact of this journal entry? Allowance for uncollectible account, it's actually an asset account, although it's the control asset account. And allowance, accounts receivable account is also an asset account. When you credit asset account, it's actually minus asset. But if you debit control asset account, you are actually increasing the asset. Hence that there's no effect on the total asset or total expenses, right? Because this entry has nothing to do with income statement at all, right? This journal entry has nothing to do with the income statement. In another word, because write-off both reduce the asset account and the control asset account, there's no decrease in total asset at all, right? And no decrease in net income. At the same time, if you remember, the negative effect of this bad debt, David's failing to pay you, this bad debt has already recorded in an adjusting entry in the end of the previous year when he borrowed you the money in year one. Hence now, this transaction does not hurt your performance in year two. Okay, that's what I meant. Accountant always conservative, always consider the cost when the things happen, when the year happened, year one, when it happened. In year two, it's just taking care of the actual, which this transaction has nothing to do with, the impact on net income at all. It doesn't even have any impact on balance sheet. So let's look at an example. Kinsey received a notice that Bruce Easley, that's a new example, has filed bankruptcy and will not pay $4,000. Okay, Kinsey write off Bruce's account receivables. So by crediting accounts receivable and debiting allowance for uncollectible account, and debiting that because this portion, $4,000 of this portion of accounts receivable is not even exist anymore. Hence, there's no point to holding allowances for it, right? So you're debiting it. And this right involves the decreasing in control asset account because allowance account usually have a balance of right hand, which is 6 million, right, or 6,000. And right now you're debiting it. It's actually reduce the credit side balance. So this, right, it's reducing it. At the same time, reducing a control asset account is equals increasing asset account. At the same time, you credit accounts receivable for 4,000 as well. Hence, this is reducing the asset, right? So there's the net effect on total asset is 0. This sentence, or this understanding is so important. I cannot emphasize enough. Okay, so the net effect of total assets when you write off your accounts receivable, when you realize you cannot you cannot collecting the receivable anymore, it has a 0 effect on the total asset and has a 0 effect on the income statement. Because the bad news has been recorded already in year 1. Okay. Okay, students mistakenly record the bad debt expenses when they write off the uncollectible accounts. It's understandable because normally people say, oh, bad things happen now, then I record it, right? You write off the uncollectible amount and record the bad debt expense when you really see David cannot pay. But bad debt expenses in our allowances method, which is the only method allowed by the GAAP, right? Is already recorded this such a negative event in the time of estimating the uncollectableness of the accounts receivable. So there's no impact in current year when there's really actually you cannot collect the accounts receivable. Okay, what if Bruce told you, oh, I went bankrupt, and then you say, okay, I have no hope to collecting that $4,000. Therefore, you debit allowance for uncollectible accounts, and then you credit accounts receivable for 4,000. When you heard the news of in file bankruptcy, and however, there's a legal process that to dissolve Bruce's asset, and later on you find out Bruce can pay you 25% of that $4,000 back, which is $1,000 of what he owed you. And then in that case, what do we do? First thing, we restate the accounts receivable Bruce owes us just for the month that he can pay us by debiting accounts receivable credit allowance for uncollectible amounts. Okay, restate that portion of relationship. And then when we receive money, okay, we debit cash and we write down the accounts receivable account for 1,000. Okay, so notice that both entry, the debit entry increases total asset, right? Increased asset. Debit accounts receivable, debit cash, increased total asset by the same amount. And the credit side, both decreasing assets by the same amount. So allowance for uncollectible account is the control asset, so it's decreasing the asset for 1,000. At the same time, it's decreasing accounts receivable for another 1,000. Hence that even he pay you back what you thought not able to collect has nothing impact on the balance sheet. Even he can pay you back what he said he cannot pay, still doesn't have any effect on balance sheet or income statement. Okay. Collection of the bad debt has no effect on the total asset or net income. So the key point we wanted to remember is that writing off a customer's account as uncollectible reduces the balance of accounts receivable, right, by debit allowances and credit accounts receivable, but also reduce the control asset allowance account, right? So that means that increasing asset and decreasing asset has its washed away. The net effect is that there's no changing in net receivable, okay? Accounts receivable lesser. So the net receivable, the net effect of writing off is no changing in the net receivable or in total asset. So in other words, whether he or she can pay you or not during the year, you're finding out during the year that you find out your customer really cannot pay you. And this event does not hurt your accounts receivable or your asset, because you already recorded such event. You have already recorded such negative event in advance. Okay, so therefore, when the write-off really happens, you need to credit accounts receivable, debit allowances, hence there's no effect on your assets. Okay, the write-off of an uncollectible account has what? Has bad debt expenses debited? No, right? We're writing off. No, bad debt expenses has been recorded in the previous year when you're estimating uncollectible account. And net income is decreases. No income statement or balance sheet effect. C, total asset unchanged. Yes, the allowance account is credited. No, the allowance account is debited, right? Debit allowances and credit accounts receivable. That way, your net accounts receivable doesn't change by what really happened during the year. What net does not change by what actually cannot collect. Okay. Okay, so adjustment for allowance for uncollectible in subsequent years is a step 3. So step 1, to restate, step 1 is we estimating how bad our uncollectibleness, which we establish debit, bad debt expense, and credit allowances account, right? Allowances accounts receivable, right? That's the first one. Step 2 is that we record the write-off by debiting accounts receivable and crediting allowance. By debiting allowance of accounts receivable and crediting accounts receivable. Right? This is write-off stage, and this is establish allowances or estimation of bad debt. Yeah. So this is step 2. Step 3 is re-establish or re-estimate next year uncollectibleness. Basically go back to the first step again, right? Okay, so it's a step 1, establish bad debt. Step 2, figure out how much you really didn't collect. Step 3, Okay, go back to think about it again and then figure out step one, year one is establishing how much is uncollectible. Step two, what really happened, actually what happened, right? Step three is to figure out what next year is. Year two, year three. Okay? Okay. So now on the year two, we need to consider aging of the accounts receivable. So we wanted to introduce another concept. So what is aging? So in our example of Kenzie, we previously established an allowance for uncollectible in 2021 by a single estimation of 30%, remember? Right? Because they had 2 million outstanding and then multiple 30%, get 600,000 uncollectibleness, right? So right now, this is no of percentage of receivable method, right? We have 2 million accounts receivable. We apply 3% percentage of accounts receivable method. And this method sometimes is referred as balance sheet method. And you don't need to remember this typical like professional words, but I just wanted to tell you. And because we base our estimation of bad debt on the balance sheet accounts receivable, right? Because this is a balance sheet account, hence that we are basing this estimation on this account. That's why we call it a balance sheet method. On the year end of 2022, we could once again apply the total accounts of receivable by a single balance, right? Older accounts are more likely to uncollectible. So consider the age of receivable. If we choose the single rate, basically we treat the new accounts receivable, and the old accounts receivable the same way. So why is it different? Think about if you have a customer who only start owing you, so you kind of loan the money for like 10 days. The collectibleness of the 10 days versus 100 days probably is much different, right? Probably 10 days you still have a high hope that they're gonna pay you back. But if it's already 100 days old, you probably feel like the likelihood of collecting is probably reduced. So therefore, using only 30% to measuring or estimating 10 days receivable versus 100 days receivable seems not fair, right? So therefore, for more accurately to figure out estimating how much is uncollectible using a single rate percentage like the Kinsey example seems not really useful. So therefore, we consider the age. That's why where's age come from? We wanted to understanding how old this receivable has been out there, right? We want to consider is this a 30 days age or 100 days age or 10 days age or 5 days or 2 years age. So the account title in the journal entry. So however, once we consider the aging method, we said the first method we talk about is the balance sheet method, right? Because we are using a single rate of 30% multiple accounts receivable, we call the balance sheet allowance method. Right now, we call it the aging method because we start to consider how long or how old the accounts receivable has outstanding. And then how do we journal it, right? We always come down to journal. The journal entry is going to be exactly same as the single percentage method, okay? But the amount will be different, okay? So we're still going to record bad debt expenses and credit allowance for accounts receivable, uncollectible amounts, okay? So how do we do that? So this is a very good example of a hospital. There's a patient, they're listing this different patient, and also others are other patients, right? So listing the patient for surely not yet due is just like just get the surgery or just treatment is 12,000, and the EMA has a $9,000 for bills that just happened, and the Phil have a $6,000 bill just not due yet. But the days past due patients, as you can see, Kara owed about $4,000 for more than 120 days old hospital bill hasn't paid, and the Ben owed 60 days old $5,000 bill didn't pay, and Anita owed the $7,000 bill. It's already more than 60 days old, right? And Noah owed $8,000 to the hospital. Is already more than within 1 to 60 days old. Hence, that if we're adding not yet due and the days past due between the category of 1 day to 60 day, 60 day to 120 days, or more than 120 days in the column wise, if you're adding them up this month, you're getting a different category of how old this accounts receivable is, right? At the same time, we wanted to apply estimated percentage of these uncollectibles. For not due yet accounts receivable, we only estimated 10% might not be a collectible. For the ones between 1 day to 60 days due, we estimated 30% it might not able to collect. From above 60 days old accounts receivable, we think maybe half of them we cannot, like $4 million, we probably at most collecting $2 million. And for the bills that are over 120 days, which is a 4 months old, we estimated probably 70% we cannot collecting anymore. Hence, once we multiply the balance of each category with the percentage or estimation of uncollectible, we adding all these uncollectibleness based on their age and different percentage, we get a new total of uncollectibleness, right? So, for example, we estimating 1.6 million the hospital bill that not yet collected yet, not due yet, not collectible. Less than 60 days bills that hasn't paid yet, maybe 2.7 million not collectible, and the more than 60 days old patients bills, probably 2 million not collectible, and then more than 120 days bills from the patient we might not able to collect 700,000. Hence, that the total that uncollectibleness of accounts receivable is about $7 million. Okay. The things that I want you to notice is that the older the bill outstanding, meaning not the bill, the receivable outstanding, the older the receivable, the less likely, right, we can collecting. And in other words, the higher the estimated percentage of uncollectibleness is increasing. Okay, and then we get a total estimation on collectibleness. So using the aging method, the key takeaway is that to estimate the uncollectible account is more accurate than applying a single percentage to all accounts receivables, right? The aging method recognizes that the longer amount accounts are past due, the less likely they are to be collected. So let's talk about how do we record step 3. Okay, step 3 is that once we write off what actually didn't collect this year, we want estimating what's not gonna, we want estimating again. We want to estimate what's not gonna be collected next year, right? So record that using aging method, the KEMSI estimated bad debt at the end of 2021 is only 6 million. Okay, such as a future write-off, we expecting as a KEMSI, they expecting $6 million of 2021's collectible accounts receivable not being able to collect in 2022. However, during the 2022, the actual bad debt was only $4 million, right? They estimated at the end of 2021, there's a $6 million they're not going to be collected. However, actually in 2022, they're only $4 million they did not collect. In other words, the year-end 2021's amount was overestimated by $2 million. So they are too pessimistic. So the year 2021's accounts receivable, they said there's a $6 million not able to collect, but actually after when they're in year 2022, they found only 4 million of this accounts receivable not collected. So they're overestimated 2 million. So using aging method, Kempsey estimated the bad debt at the year 2022 is actually 7 million. So basically what it means that during 2022, you have a new accounts receivable happening, right? You have a new accounts receivable, you have a new credit sale, plus your old accounts receivable balances. And then you're using the aging method, right, which is this slides we just talked about. You find that in 2022, you estimated that your uncollectableness of everything happened to your credit sales is $7 million. So how does Kempsey record its $7 million estimated future debt expense at the end of 2022? Do we just naively debit bad debt expense for 7 million and credit allowances for 7 million? No, right? Because this 7 million is actually telling us the allowance amount, this account at the end of the day, at the end of year 2022 should be 7 million. It's not the change of the allowances account is 7 million. So I will show you in detail next one. So balance of Kempsey allowances uncollectible account. This is allowance account, right? So at the beginning of 2022, remember 2021 estimate is the 6 million uncollectibleness. And then during the 2022 is write off 4 million. So I will write down. So during the year end of 2021, year end, we estimate the bad debt expense for 6 million, we credit uncollectableness or allowances for 6, right? And then we write off, meaning that we really find out that our actual uncollectible is actually 4 million. We write off allowances account and write off our accounts receivable by 4 million. So balance before adjustment for this allowance account should be 2 million, right? However, using aging method, we know at the end of the day, the 2022, we should have a $7 million. Hence, to record a year-end adjustment, we should have 5, right? So therefore, we will credit 5 million here, and then debit bad debt expense for only 5 million. Because the aging method is talking about what should be, what the end is. What the end is, we only want to see 7 million under allowance account as ending balance. Hence, we need to back out how much adjustment we should make during 2022. In other words, on the balance sheet of the 2022, the allowances account, regardless what happened during, the ending balance should be credit side 7 million. And then the bad debt expenses, as we redact it, we work backwards and we find we need a record 5 million. Hence that this 5 million is hitting the income statement in year 2. Okay. So what happens if we're underestimating the bad debts? For example, what if the actual bad debts in 2022 were 6 million compared to an estimation of 5 million? In other words, let's see. So at the beginning of the balance of 2022, right, we said we have 5 million of uncollectibles. However, during the 2022, we actually write off 6 million. That means we're underestimating the bad debt situation in year 2021, right? And then that means there's the adjusting balance of allowance account has a debit side of 1 million. But based on the aging record we used, we know at the end of the 2022, we should record 7 million. So therefore, how much we should credit in here? We should credit in 8, right? Because there's so, or you can say 5 plus 8 equals, so you can set up x, 5 plus x minus 6 equals 7, x equals 8, right? Right. So there's how we get this year-end adjustment. So we were crediting 8 for allowances for this 2022 with debit bad debt expenses. Okay, so let's look at how does people talk about the bad debt expenses in their annual report. So let's say the healthcare corporation is that the preparation of financial statement in conformity with the accounting principle generally accepted GAAP in United States requires us to make estimates and assumption that affect amounts reporting on consolidated financial statement and these accompanying notes. We regularly evaluate accounting policies and estimates used. In general, we base estimation on historical experience and on assumption that we believe to be reasonable given particular circumstances in which we operate. Although we believe all adjustment considered necessary for a fair presentation has been included, actual result might vary from those estimations. All this paragraph is saying that it's a note to our financial statement. It's saying that the allowances account, they estimated the percentage is based on the historical, right? It says the historical experience and assumptions. However, when the really write-off happen, it might vary from those estimates. But this is example showing you that the company does taking care of their accounts receivable and regularly adjusting their bad debt expenses to reflecting the circumstances of the company. Okay, let's do a concept check. When an entry is made to write off uncollectible account, what do? We know when we record a write-off, there's no balance sheet or income statement effect, right? Hence that there's definitely bad debt expense is not debited at all. It's happened when you estimating the bad debt, right? And then net income is decreases. No, there's no income statement effect. Net account receivable is unchanged, right? Because you debit allowances account the same amount of your crediting the accounts receivable account. D, the allowance account is credited. No, the allowance account is debited, right? Okay, which of the following is true about the aging method? A, no estimate for uncollectible account is made. No, aging method is to consider different past due accounts receivables, right, using different percentage. Older accounts are more likely to be collected. No, it's opposite. Older accounts, the longer the people waiting to pay you, the less likely they will pay you. The dimmer the hope is the dimmer that the hope that you're gonna get paid is, right? So it is not acceptable by GAAP. No, it is acceptable. Older accounts are less likely to get collected, right? Okay. So now we want to talk about what if you don't use an allowance method. So no matter it's the percentage of accounts receivable or balance sheet method or aging method, both we call it allowance method. meaning that we estimate the bad debt expense before the bad debt actually happens, right? This is called allowance method. The allowance method. And this is kind of gap required. Okay, gap required. And there's another method called directly write-off, which is intuitive. It's like a cash-based accounting. You only record bad debt expenses when you see it's uncollectible. Okay, so we want to comparing those two. First of all, direct write-off method is not GAAP. GAAP doesn't allow you to use this method. But for you to better understanding what really happened to accounts receivable, by doing this comparison might help you understand it better. So write off bad debt only at times they actually become uncollectible. So unlike the allowance method, which requires estimation of an uncollectible kind of before they even occur, right? The write-off bad debt, the direct write-off is when you write off the bad debt or debit bad debt expense and a write-off accounts receivable when this actually happens. It's only used when uncollectible accounts are not anticipated or immaterial. Okay, it's not allowed by GAAP anyway. If you publish the firm that you wanted to publish your financial statements on the stock exchange, you cannot write this method. Primarily used for tax purpose. Okay, so let's look at what's the comparison. So under allowance method in 2021, you estimated $2,000 of uncollectibleness, hence that you're debiting bad debt expense and crediting allowance for UA account, right? And then direct method is that you have not the direct write-off method, you don't need to do anything because there's no bad debt happen yet, right? However, in 2022, when there's actually write-off, when actually the people file bankruptcy, when actually they called you or email you say, hey, I cannot pay for that $2,000, what happened is that in allowance method, you write off that accounts receivable by crediting the $2,000 and debiting the allowances account to make sure the net accounts receivable is not changing. Okay, and at the same, but if under the direct method you debit bad debt expense at that point when you find out that you actually cannot collect in 2000 and you credit in accounts receivable. So what's the difference? What is the impact of financial statements? So if you if you notice, this class is always talk about the measurement and the communication at the same time. Whenever we talk about a journal entry, we will always want to consider what's the effect on the balance sheet, on the income statement, right? What would this journal entry do in terms of financial statement? Okay, so if we use allowance account is credited for the estimation and the debit the actual write-off, the balance cancels, right? So over the both years, the net effect to the debit of balance, debit bad debt expenses and credit accounts receivable. In the end, if you notice, no matter you are using allowance method or the direct write-off method, the real effect here is actually record an expense, right? Expense increase and asset decrease. Using direct method, it's the same thing, increase expenses and decreasing assets, right? But using allowance method, you use a buffer account called allowance account to separating the time, right? From year 1 to year 2. And using this buffer account, you actually conservatively record the negative news when you should record it instead of wait it to happen. And the big difference between these two, like I said, is one using this buffer account to record the bad debt expense when you have accounts receivable, and the direct write-off method is to record this bad debt expenses when it is really happening. Okay, so common mistakes is some students erroneously think that firms should reduce the total asset and report bad debt expenses at the time the bad debt actually occurs. However, companies should anticipate future bad debts and establish an allowance buffer for those estimations. The reason of the benefit of doing so is that your company's operation is not going to be driven by all of a sudden a lot of people fail to pay you, or all of a sudden everybody can pay you. By using allowance account, you controlled how much bad debt expenses you have to endure in every period. Not drive is using allowances account, creating a buffer for the fluctuation of reality that customer do not pay altogether, right? So if you use direct method, think about it. You say you have $1 million accounts receivable outstanding, all of a sudden everybody failed to pay you. So direct method, they directly write off on that year, say year 2020. Oh, that's a bad news for you for sure. Bad debt expense for 1 million, and the accounts receivable write off for $1 million. Then you will take a big hit on that year. But if you using allowance method, when the write-off really happen, remember when the actually write-off will only debit allowances account. We are crediting accounts receivable account. There's no impact on your income statement. Okay. Okay. Key point: the direct write-off method wait to reduce accounts receivable and report a bad debt expense until the accounts receivable prove uncollectible in the future. This leads accounts receivable being overstated all the time in the current year. Think about all the accounts receivable might endure uncollectibleness, right? So as long as you offer credit sale, you are taking risks of not being paid. Hence, every time you debit accounts receivable credit sales, that you offer credit to your customers, you should already record the bad debt expense, because that's the cost that you endure or you're willing to take on to offer your customer credits, right? So therefore, direct write-offs generally is not a good method at all, because if you do not record bad debt expenses while you're offering credit sales, you're basically overstating your accounts receivable. You're overstating your assets. You really do not have that much money. You do not really have that much asset. But you said you will because you didn't consider bad debt expenses. You're overstating your assets. Okay, concept. On December 31st, before adjusting entry, right, the company's balance of allowances or uncollectible account is credited for 2,000. So allowances account has a credit before 2,000, before adjusting. Okay, and prior to adjusting entry. So the company did not estimate bad debt last year. No, it's not. It did, right? Because this $2,000 definitely coming from bad debt expense and credit allowances. That's why they have $2,000 balance. Okay, so this is wrong. B, last year's estimation of bad debt was too low. I think it's too high, right? Because think about before adjusting, so you have 2,000, right? And then you only write off 1,000, and then you have a 1,000 left now. Hence that before adjusting, you actually overestimated, right? So no. So a company's estimated equals the actual bad debt. No, it's not. If it's equals, then you should not have a credit side of 2,000 anymore, right? So last year estimation of bad debt was too high. Okay, so let's look at what I think it should choose D. So the allowance for uncollectible account is a contra account with a credit balance. The balance is reduced or debited for actual bad debts. If the account balance at the end of the year before adjusting the credit, then estimated bad debts for this year are greater than this year's actual bad debts. Okay? Yes. Okay, another example. On December 31st, before adjusting entry, a company reports following balance. The accounts receivable is 100,000 and the allowance for uncollectible amounts is 2,000 on the credit side. The company estimated bad debt to be 20% of receivable. Okay, as of next year, right? So adjusting entry should be. So basically, before adjusting, you have accounts receivable for 100,000, and you have allowances for uncollectible account for 2,000. This is before adjusting. Before you adjust your allowances for bad debt for next year, for subsequent year. Yeah, okay. So therefore, if the company is saying that the bad debt is to be 20% of accounts receivable, so if 20% multiple accounts receivable is gonna be 20,000, right? So therefore, we should debit bad debt for something and credit allowances for something. It says, read this clearly. The company estimates the bad debts to be 20% of accounts receivable. It didn't say the bad debt expenses should be 20,000. What it is saying, what is this sentence saying is that the allowances account for next year, the allowances for this $100,000 that to be collected. So the bad debt happened to this $100,000 that to be collected should be $20,000 here. That means that next year, I only expect to collect 20% of this 100,000. Hence, how much bad debt expense I really should debit in here, and allowance of uncollectible accounts. As we just showed a little bit earlier, we should back out this X, right? So let's say 2,000 plus X equals 20,000. So tell me X equals 18,000, right? So we should debit 18,000 by that credit allowance for 18,000 to make sure the balance of an allowance account or the estimation of bad debt to be collected, to be not able to collect it, is 20% of the final balance of accounts receivable. So therefore, we debit the bad debt expense. Okay, let's read what the answers sheet is. It's a little bit clearer. Oh, by the way, I from what the office hour that I learned is that if you actually take some time besides doing Learn Smart and listen to the lecture or reading the PowerPoint, actually there's another way to learn very well is to read your book. Okay, because Learn Smart, I only assign you 1 hour at most, but you know the content of each chapter is way more than 1 hour. And when you come to the lecture, I can give you 1.5 hours, but I have to clearly and dice it up to give you exercise and the lecture at the same time. And while I'm giving you the recordings, although it's kind of over 3 hours here and there, but I also only summarize things that most important, right? So therefore, the heavy lifting of learning is still up to you, and you need to read the book word by word to understand it better. Okay, so this choose A because bad debt are estimated to be 20,000 because it's 20% of accounts receivable balance. The current 2,000 credit balance on the allowances need a credit adjustment of 18,000 to be equal to 20,000. The adjustment of 18,000 is recorded as a debit to the bad debt expenses and a credit to allowances for allowance for uncollectible accounts. Okay, so I wanted to stop right here, and I've covered everything that I needed to cover in terms of accounts receivable. I just wanted to tell you in accounts receivable, bad debt, you need 3 steps. Step 1 is to record bad debt by debiting bad debt and crediting allowance. Step 2 is when you are in the set year 1, year 2. When you during the year 2, you find out people really cannot actually not paying you. You are debiting allowances account and crediting accounts receivable, right? And in the end of year 2, end of year 2, end of year 1, you needed to re-estimate your bad debt experience, bad debt account. Hence that you were still debiting bad debt expense by a new amount, right? And crediting allowances account by a new amount. Okay, that's it. Step 1, step 2, step 3. Okay. Okay, I will talk to you guys in the next video.